Hello, ladies and gentlemen. A huge welcome back to the special weekend edition of Markets Around the World. My name is K2, and as always, we'll be covering everything from the latest data and macroeconomic news stories to the key levels you need to watch. If you love markets like we do, remember to subscribe and educate yourself on how these markets actually work together. Now, let's talk about what happened in the market and what to expect in the future. Let's expand the conversation, starting with the news. The week began with a market plunge that would make even the most seasoned space traveler reach for a sick bag. The S&P 500 nosedived, dropping 3% faster than a meteor entering Earth's atmosphere. This was due to a mix of geopolitical jitters, confusing economic data, and the unwinding of the yen carry trade, which is like a cosmic game of financial Jenga. Tech's wild ride. Tech stocks, the usual suspects in market drama, went from zero to hero. After a rough start, they rebounded with the strength of a spring-loaded rocket, thanks to positive corporate earnings and whispers of softer inflation data. Imagine your spaceship taking a detour through a black hole, but then correcting course to warp speed. Inflation's plot twist. Inflation data came out cooler than a cucumber in a Martian greenhouse, leading to market speculation about the Federal Reserve possibly cutting interest rates. For investors, this was like winning a free trip to a galaxy far, far away. Market sentiment swings. Investors were on an emotional roller coaster. One day they were convinced the economy was on the brink of collapse, and by week's end, they were toasting to a Goldilocks economy. Not too hot, not too cold, just right for market growth. The Fed's next move. The market is now playing a game of guess the Fed's next move, akin to predicting the actions of a bureaucratic alien. There's talk of a rate cut in September, signaling that the party might just be getting started. Sector performance. While tech and growth stocks were the life of the party, sectors like real estate, utilities, and healthcare decided to sit this one out. It's as if some sectors were at a market disco, while others were quietly sipping intergalactic punch. Powell is set to speak on the economic outlook at 10 a.m. Eastern Time, continuing the tradition of Fed chairs delivering a keynote speech during the high-profile annual gathering that draws top U.S. and global central bankers. The event, held at Grand Teton National Park in Wyoming, runs from August 22 to 24. While Jackson Hole is not typically a venue where Fed chairs deliberately direct expectations about upcoming interest rate decisions, Powell's speech this year will be closely watched. This year's conference comes on the heels of extreme market volatility as traders adjusted their expectations for the Fed's rate path. A softer-than-expected July jobs report triggered a sharp stock market sell-off just 2 days after the Fed's last meeting in July. The next jobs report is due out just before the start of the Fed's communications blackout period, ahead of its September meeting. For the past few years, many Americans have felt economic strain. Inflation peaked above 9% in 2022, and though it has eased, prices for many goods and services remain well above pre-pandemic levels, hitting lower-income households the hardest. The labor market has also shown signs of stress, with declining job openings and rising unemployment. While the market has recovered somewhat and unemployment remains at historically healthy levels, the effects are still felt, especially among young people facing higher unemployment. The recent memory of pandemic layoffs adds to the anxiety. When the July jobs report showed 4.3% unemployment, it sparked discussions about the SOM rule, which indicates a potential recession if the unemployment rate's 3-month moving average rises by 0.5 percentage points from the previous 12-month low. Following the report, Google searches for "Are we in a recession?" surged, and major stock indexes dropped, suffering their worst trading day of the year the following Monday. Gold prices have soared to new all-time highs, reaching levels that even seasoned investors find surprising. There's growing chatter that these record highs could be signaling an impending recession. Analysts are discussing terms like recession and market bubble with ease. Market sentiment is highly volatile. Some view gold's rise as a warning of economic downturns, while others see it as a safe haven amid geopolitical tensions. There's talk of a shift toward defensive sectors, with gold leading the charge, like preparing for a meteor shower by investing in spacesuits instead of spaceships. Gold has been the star of the market, with prices up over 20% this year, like discovering a new galaxy made of gold. Some analysts predict gold could reach $3,000 an ounce, a bold forecast akin to finding life on Mars and expecting them to wear gold. The situation, especially in the Middle East, has driven investors to gold as a safe haven, much like a lifeboat on a sinking ship. Mixed data suggest both economic recovery and potential downturns, creating uncertainty akin to a sci-fi movie where the fate of the spaceship is unknown. In summary, gold has been on a wild ride, breaking records and capturing attention. Whether it's a sign of economic trouble or just a shiny distraction, time will tell. For now, gold enthusiasts are in for an exciting journey, like having a ticket to the most exclusive space party in the galaxy. Let's expand the conversation and dive into some data. We'll begin with NAAIM Exposure Index confirms. Defensive rotation. What about the smart money, represented by money managers? The NAAIM Exposure Index, which reflects the weekly survey results of the National Association of Active Investment Managers, provides insights. This index represents the average allocation to equities in their client portfolios. When the indicator is above 100%, as it was in late June, it suggests a euphoric sentiment and a higher likelihood of corrective market action. VIX signals extreme volatility. The VIX spiked to 65 on an intraday basis this week, marking the third highest reading since the Great Financial Crisis in 2008. In fact, the indicator has only exceeded 40 a few times in the past decade, typically during significant market corrections. The other data I want to show you guys is periods of extreme market concentration highlight the dominance of top stocks over the past century. Recent trends indicate that leading stocks have seen significant increases in market capitalization compared to their peers. What are your thoughts on this growing concentration? Fund managers have significantly increased their allocation to U.S. equities relative to Japanese equities, reaching the highest level since November 2021. This notable shift reflects a strong change in market sentiment, suggesting a growing confidence in the U.S. market compared to Japan. The surge in allocation underscores a shift in investment strategy, possibly driven by differing economic outlooks or market conditions between the two regions. Britain's strong performance in 2024. Britain has outperformed its major peers in 2024, leading the group of 7 nations with the strongest economic growth in the first half of the year. The UK economy is showing a favorable balance with several positive indicators. Inflation is slowing, employment is rising, and economic growth remains robust. Official data highlights the fastest hiring pace since November and inflation rates that are lower than anticipated. This combination of factors suggests a resilient and improving economic environment for the UK. Gold surges past $2,500 per ounce spot. Gold has surpassed $2,500 per ounce for the first time, driven by growing expectations of interest rate cuts from the U.S. Federal Reserve. The precious metal jumped by as much as 2.2% following disappointing U.S. housing data, which fueled predictions of imminent rate cuts. Gold, which benefits from lower interest rates, has surged over 20% this year. This increase is supported by optimism around monetary easing, higher central bank purchases, and escalating geopolitical risks. The Nasdaq 100's valuation reached its lowest point since late 2023, following a sharp sell-off on August 5th, when the index dropped over 5%. Initial concerns about a potential tech bubble burst were quickly eased by reassuring economic data, which sparked a subsequent rally. The Nasdaq 100 has since rebounded, with major tech stocks like Nvidia and Apple leading the gains. Despite the strong outlook for the tech sector, concerns about valuations and the long-term profitability of AI investments continue to linger. The last data for this video is U.S. money market fund assets have reached a new all-time high of $6.19 trillion, driven by $52.7 billion in weekly inflows. This increase reflects a shift by investors towards cash amid a global sell-off in risk assets. Let's add some color to this video by checking out the heat map of recent market activity. Microsoft was up 3%. Nvidia surged a staggering 19%. That's absolutely incredible. Apple gained 6%. Amazon also saw a 6% rise. Tesla was up 8%. Overall, the heat map was a sea of green, with the only red spot being Chipotle. The S&P 500's performance. The S&P 500 had a week where it seemed like every stock was trying to outshine the others, resembling stars in a galaxy. The heat map displayed mostly green, with only a few red spots, showing that most stocks were on an upward trajectory. Top gainers. On this heat map, the brightest colors would be reserved for companies like Starbucks, Supermicro, and Nvidia, which skyrocketed like rockets in a space race. They'd be the glowing supernovas on this chart. Top losers. Conversely, companies like Chipotle and Hershey might have been the black holes of the week, pulling down gains with their losses. However, even these losses were relatively minor, compared to the overall positive trend. Fear and Greed Index Update. The Fear and Greed Index is currently in the fear zone at 35. It's a cautious position, akin to deciding whether to jump into a black hole, but not indicative of panic. Historically, the index has swung from extreme fear during the 2008 financial crisis to high greed before the 2020 crash. Right now, it's balanced, neither too high nor too low. In summary, the Fear and Greed Index reflects a cautious but stable market. It's a good time for investors to either buy with a long-term view or observe the market's movements as spectators. Remember, market emotions are just part of the show for those watching from the sidelines. This week's most notable earnings Monday: Palo Alto Networks, Estée Lauder, Zim Integrated Shipping Services. Tuesday: Lowe's, Toll Brothers, Medtronic, Workhorse Group, Xpeng. Wednesday: Target, Macy's, TJX Companies, Urban Outfitters, Snowflake, Zoom Video Communications, Analog Devices, Agilent Technologies, Zix Corporation. Thursday: Baidu, NetEase, Workday, Intuit, Peloton, Cava Group, BJ's Wholesale Club, Ross Stores, Advance Auto Parts, Williams-Sonoma. Friday: no major earnings reports. SPY 4-hour chart analysis. What an absolute wild ride. The bulls have won the battle for now. There's a final opportunity for the bulls to make their move. If the price gaps up above 555 and holds, we could see a push to new all-time highs. However, if the price falls, we might experience more downside, depending on the Fed's speech this week, which could trigger a major pullback. For now, futures are green, so let's see what unfolds. Looking at the QQ 4-hour chart, my concern for this week is the potential development of an ABC pattern. We're currently at the Fib 0.618 level, which could indicate a zone for more downside. If the price breaks above 490, the bulls will have won the battle, potentially pushing the price to new all-time highs. Are you considering shorting QQQ in this zone, or will you wait to see if the price breaks above 490? Examining the NVDA 4-hour chart, here's my strategy for potentially shorting this major stock. If the price breaks above 126, I'll refrain from shorting, as this could signal strength and a continuation of upward momentum. However, if the price is rejected at this level and shows signs of a reversal, I'll look to short NVDA aggressively. This approach hinges on the price action around the 126 mark. If it fails to hold and turns down, it could present a strong shorting opportunity. Key events. This week: Monday, Fed's Waller speech, Palo Alto Networks earnings. Tuesday, earnings reports, Lowe's, Toll Brothers, Xpeng. Wednesday, Fed FOMC minutes. Earnings reports, Target, Macy's, TJX Companies, Snowflake, Zoom Video Communications. Thursday, initial jobless claims, manufacturing and services PMIs, existing home sales, Jackson Hole Symposium. Earnings reports, Baidu, Cava Group, Ross Stores. Friday, new home sales, Jackson Hole Symposium, Fed Chair, Powell's speech. All right, ladies and gentlemen, that's all for today's video. If you found value in this content, please like and subscribe. If you have any questions, feel free to leave them in the comments, and I'll get back to you as soon as possible. Thank you all for watching, and see you next time. Bye for now.